pressure. Let's explore trading psychology. Welcome to the world. Let's explore trading psychology. Welcome to the world of trading psychology. In this lesson, you'll discover how emotions often impact your trades more than your actual strategy. Even the best strategy can fail if your mindset isn't prepared. Many traders spend years refining strategies but still lose money. Why? Because strategy alone isn't enough. Without the right mental habits, even a solid plan breaks under pressure. The execution gap is the space between knowing what to do and actually doing it in the heat of the moment. It's often emotion, not logic, that widens this gap. Fear whispers, "Don't enter." It makes you doubt your analysis, second-guess your plan, and exit early. Recognizing fear is the first step toward managing it. Greed seduces you into overtrading and overstaying. After a win, it tells you to double down. Left unchecked, it leads to poor decisions and bigger risks. And sometimes we trade just to feel in control. Boredom, feeling of missing out, or the urge to act led to impulsive trades with no plan. These are the trades you regret the most. A loss can ignite the urge to immediately win it back.
Yes, you're right.
After a loss, many traders feel the urge to jump into another trade just to win it back. This is called revenge trading, and it widens the execution gap by pushing you to abandon your rules and act impulsively. A disciplined trader accepts the loss, steps back, and waits for the next valid setup. We all want to be right, but when traders only seek information that supports their bias, they ignore critical warning signs. Objectivity is key. After a few wins, however, confidence can morph into overconfidence. It leads to oversized trades, ignored stop losses, and costly errors. Traders often cycle through all these emotions: excitement, fear, panic, relief, and regret. Awareness of this cycle helps you pause and act rationally. Time for a quick quiz. You've patiently waited for a textbook breakout setup. The price moves exactly as planned, but just before your target, you feel a surge of confidence and decide to double your position size mid-trade, ignoring your risk plan. What is the most likely outcome of this emotional decision? You lock in your planned profit safely. You reduce your risk by tightening your stop loss. You exit the trade at the right time, according to your plan. You take on excessive risk, and a reversal wipes out your earlier gain.
Yes, you're right.
Exactly. Sudden changes to your trade size when feeling confident can undo all your careful planning. Keeping to your original strategy, especially regarding risk, is what helps you protect your profits, even when things seem to be going your way. How to avoid that? Before taking any trade, check your emotional state. Ask, am I calm or am I reacting? Self-awareness is the trader's secret weapon. Time for a quick quiz. You just took a well-planned trade, but it hit your stop loss. Now you feel frustrated and tempted to jump into a new trade immediately. What should you do next? Re-enter to win it back. Double your next position. Review and reflect calmly. Try a random trade to reset.
Yes, you're right.
Smart move. Losses are part of the game. Reflecting calmly helps you learn, stay objective, and prepare for the next valid setup. You've learned how emotion can affect trades in real time. But what about after the trade is over? In the next lesson, we'll explore hindsight bias, a subtle illusion that makes you believe outcomes were obvious. Understanding it is key to objective learning. I knew it all along. Traders often fall prey to the illusion that past events were easily predictable. In this lesson, we'll examine how hindsight bias clouds our judgment and what this means for our decisions and beliefs. Imagine this. You just closed a great trade with a solid profit. You lean back, feeling proud. The chart looks crystal clear now, and you start thinking, that setup was perfect. I knew it would work. In that moment, it's easy to forget the uncertainty you felt before placing the trade, or how many similar setups you've seen fail. Looking back, everything seems obvious. but that's because you already know the outcome. The market didn't guarantee it. It just happened to work this time. This is called hindsight bias. When you believe a successful trade was clearly predictable all along, it builds false confidence, leads to risky decisions, and blinds you to real uncertainty. Spotting it helps you stay grounded and trade more objectively. Believing that a trade was obviously going to work just because it succeeded is a sign of strong market analysis.
Yes, you're right.
Just because a trade worked out doesn't mean it was clearly predictable. That's hindsight bias, and it can lead to overconfidence and risky decisions. Real analysis includes recognizing uncertainty, not ignoring it. Now let's consider the opposite scenario. The news looked strong, technical indicators lined up, and your confidence was high. You went all in, convinced this trade was a clear opportunity, but the market moved against you quickly. The stock plunged. A surprise earnings miss sent investors scrambling. What looked like a textbook setup unraveled in seconds. As the chart turned red, you were left questioning your decision and wondering if the warning signs were there all along. After a losing trade, hindsight bias can show up in a different form. Instead of confidence, it brings self-blame. You start thinking, I should have seen it. The signs were there. How did I miss this? But pause for a moment. Were the signs really that clear, or are you just seeing the trade through the lens of the outcome? That's hindsight bias again, convincing you that what happened was always obvious, even when it wasn't. Time for a quick quiz. You just lost a trade, and now you're looking at the chart thinking, it was obvious the level wouldn't hold. What's the most accurate explanation? You ignored all technical analysis. You missed a clear and easy signal everyone else saw. You were overconfident and deserved the loss. You're experiencing hindsight bias. You're projecting certainty onto a past decision.
Yes, you're right.
Exactly. You're experiencing hindsight bias, the belief that the outcome was obvious after it happened. At the moment, the setup may have been valid. It's easy to feel certain after the result, but that's a distortion, not clarity. One of the most prominent examples of hindsight bias in the financial markets is the dot-com bubble of the late 1990s. During this period, many investors believed that the rapid growth of internet companies was a sure thing, and that the stock prices of these companies would continue to rise indefinitely. However, when the bubble eventually burst in 2000, many of these same investors claimed that they had seen it coming all along. In reality, the dot-com bubble was a highly unpredictable event that caught many investors off guard. After the crash, many claimed they had predicted it, showing hindsight bias, despite having little evidence to support those claims at the time. So how do you avoid hindsight bias? Start by accepting that uncertainty is key to thinking clearly and improving your decisions over time. Build the habit of trade journaling. Write down your reasoning before each trade. 1. What setup are you seeing? 2. Why is it valid? 3. What's your risk and target? When you review later, compare your plan with the outcome. It keeps you honest and helps separate emotion from process. You can't control the outcome of every trade, but you can control how you think, review, and act. Recognizing hindsight bias is the first step. The next, discipline, the habits and routines that protect you from emotional decisions in the moment. That's what we'll explore next. It's time to build your discipline. Discipline is your trading anchor. In this lesson, you'll learn how to stick to your rules and build habits that lead to long-term success. Most traders don't fail because of bad strategies. They fail because they don't follow them. Discipline is the bridge between knowing what to do and actually doing it. Without it, even the best ideas fall apart. With it, consistency becomes possible. Imagine this: you plan to only trade confirmed breakouts. But when price moves fast, you panic and jump in early, violating your rule. That's a discipline issue, not a strategy flaw. Discipline shows up in small, repeatable behaviors. For example, only trade clean setups. Always use a stop loss. Risk no more than 2% per trade. It's not about perfection, it's about consistency under pressure. The market looks hot, and you enter a trade even though it doesn't meet your plan's criteria. You trust your instinct this time. This is a smart, disciplined decision.
Yes, you're right.
It's easy to justify impulsive trades when the market moves fast. But true discipline means saying no to setups that don't meet your plan, even if they look promising. That decision might cost you short-term excitement, but it protects long-term consistency. Here's what disciplined trading looks like in action. Coin followed his plan all week. He capped risk at 2% per trade, waited patiently for confirmed setups, and stuck to his stop-loss and profit targets without hesitation. Over 18 trades, most ended in profit. His $5,000 account grew steadily to $5,725, a 14.5% return in just 5 days. No hype, no guessing, just consistent execution. But discipline is not tested during the good times. It's tested when temptation strikes. On Friday, Coin saw a tweet that read, "This stock is about to explode." Without checking his system, he jumped in with his full balance, $5,700. This is the part most traders learn the hard way. One moment can undo days of focus. The market dropped hard. Within minutes, he was down $600. One impulsive trade erased 5 days of focused effort. That loss was preventable. Discipline isn't just about what you do in the trade, it starts long before. A solid routine, grounded in preparation and self-awareness, helps you avoid emotional traps before they appear. Growth doesn't come from one perfect day. It comes from doing the right thing over and over. Discipline is earned, and each small win helps you climb a little higher. Time for a quick quiz. It's late Friday. Coin is down slightly for the week. A new setup pops up, but it's not ideal. He's tempted to risk more to end the week green. What's the disciplined decision? Double the position. It's the last chance this week. Take it. Ending green boosts confidence. Skip it. No solid setup means no trade. Forget rules. Gut trades are okay on Fridays.
Yes, you're right.
Exactly. The disciplined trader knows that one trade won't make or break their career, but bad habits can. If the setup isn't strong, the right move is to sit out. Sticking to your rules builds long-term consistency, not chasing short-term redemption. In short, discipline means skipping low-quality setups, following your rules even after a loss, walking away when you hit your limit. Knowledge check. What does discipline look like? Pick the actions that reflect strong trading discipline. Discipline is your edge. It's built through daily choices, following your plan, avoiding impulse, and staying consistent. These habits shape long-term success. Ready to test how well you've locked in this mindset? Let's see what you've learned.
In the middle of a trade, you start hesitating, second-guessing your plan, and exit early. What emotion is likely causing this reaction? Greed, overconfidence, fear, boredom. What is revenge trading? Trading with strict rules and discipline. Taking a break after a winning streak. Jumping into a trade after a loss to win it back. Doubling your risk after you hit your profit. 2. What is the danger of hindsight bias? It forces you to be too cautious and avoid trades. It helps traders know the future. It improves your forecasting skills. It creates false confidence or unnecessary self-blame. 3. What does overconfidence usually lead to after a few wins? More careful and smaller trades. Switching to long-term investing. Lower risk and tighter discipline. Oversized trades and ignored stop losses. 4. What should you do after a losing trade? Immediately jump in to recover the loss. Increase your position to make up for it. Reflect calmly before taking another trade. Forget your rules and act on instinct. 5 in a row. What is one major cause of impulsive, planless trades? Boredom, FOMO, or the need to act? A. Clear trading setup. A. Proper risk-reward ratio. A. Detailed plan. 6. What is a strong way to reduce hindsight bias? Avoid looking at charts too often. Only trade after losses. Rely on gut feeling and market hype. Write down your reasoning before every trade. 7. Why is it risky to act on trades that aren't part of your routine? Because routines only matter for investing, not trading. Because following a plan guarantees profits. Because routines make trading boring. Because impulse trades often ignore planning and increase risk. 8. Which of these is a sign of trading discipline? Skipping a setup that doesn't match your plan. Entering extra trades to end the week green. Ignoring your stop loss for more profit. Doubling your size after each win. 9. Why should traders be cautious about last-minute trade ideas? Because those trades are usually based on solid fundamentals. Because consistency beats last-minute excitement in the long run. Because trades on Fridays always lose. Because the market closes on weekends.